Let's take a look at this intra-entity sales problem. All right, I'll read the problem to you. You see it at the top of the screen. Akron Inc. owns all outstanding stock of Toledo Corporation. Amortization expense of $15,000 per year for patented technology resulted from the original acquisition. For 2015, the companies had the following account balances, and you can see it to the right of my mouse here. They give the sales amount, the cost of goods sold amount, operating expenses, no information on investment income for Akron in the first year, 0 for Toledo in the second, and then the dividends declared per year. Now, they then tell us that intra-entity sales of $320,000 occurred in both years, 2014 and 2015, and in both years the merchandise cost $240,000. They tell us that of the total transfers, $70,000 was on hand at the end of 2014, and $15,000 was unsold at the end of 2015. Okay, then they ask us to prepare the consolidation entries required by Akron in 2015. I apologize for my stuttering. And then we need to prepare a consolidated income statement for the year ended December 31st. Okay, now if you look in the main portion of the screen, you see right here that I've added a little schedule. And the reason why we need to prepare the schedule is we need to determine what the gross profit is on the unsold inventory at various points. Now, the sales and cost of goods sold was the same, so we had gross profit of $80,000, which is a 25% gross profit percentage. Take the $80,000 divided by 320, and that's how you get the 25%. If the unsold inventory was $70,000, then the gross profit on the unsold inventory would be 25% of that amount, or $17,500. For 2015, it was $50,000 unsold, so 25% of that is $12,500. Okay, Part A, we need to prepare the consolidated entries. In Part B, we're going to prepare a consolidated income statement. So let me slide down and we can get started on this. Let's leave it right about here would be good. Okay, so we need to prepare the consolidated entries required by Akron. So let me slide this one down so we can focus on the first entry. The first entry we need to do is calculate, and by the way, we're working with the 2015 consolidated financial statements. We had $17,500 gross profit in beginning inventory. Now, we need to reduce that. We need to eliminate that gross profit in beginning inventory. And the way you do that is you debit retained earnings $17,500 and credit cost of goods sold. Right? This is, if you will, reversing the impact of the gross profit in beginning inventory. Now, they also told us that there was amortization of the patented technology. We need to record that. We do that by debiting amortization expense of $15,000 and crediting patented technology of $15,000. And then the third entry we need to do is eliminate the sales. The sales for year 2015 was $320,000. So we eliminate the intra-entity sales by debiting sales and crediting cost of goods sold. And then, of course, the last thing we need to do is eliminate the unrealized profit on the remaining inventory at the end of the year. And that was $12,500 that we calculated above. So we debit cost of goods sold and credit inventory of $12,500. So in this, you see that related to the inventory, we really have three entries. We've got to eliminate the profit on beginning inventory. We need to record the intra-entity sales. By the way, that's the gross profit on intra-entity sales. Then we eliminate the full year sales, and then we adjust for the gross profit on the inventory that's remaining on hand at the end of the year. Okay, and then the last part of this is they say prepare a consolidated income statement for the year. So let me adjust the screen next, and we'll take a look at that. Okay, now I've adjusted the screen so that we can still see most of the problem up at top as well as the answer to Part B in a legible format. So what do we have to do now? We prepare the consolidated income statement. So again, what we're doing was we're adding the results of Akron and Toledo together, but then we need to also take into consideration the adjustments we made on Part A. And when we do that, when we add the two together and eliminate the sales and the patented information, as well as the unrealized inventory profits that existed at the end of 2014 and 2015, we come up with sales of $1,380,000, right? Cost of goods sold of $575,000 and operating expenses of $635,000. So the end result is that we have consolidated net income of $170,000. Okay, I hope you found this beneficial. Thank you.